My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends, just trying to make some money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. The hatred for this market, okay, it knows no bounds. And I can't blame the haters. Every time you get comfortable, someone pulls the rug out from under you, which is how you get a not-so-hot day like today, where the Dow slips 177 points, S&P declines 0.75%, NASDAQ lost 0.72%. Part of the big rally last week came from the financials. How great was that to see? Specifically, the terrific comments made by Jamie Dimon, the CEO of J.P. Morgan. He talked up the consumer. How is banks doing well in this environment where the Fed's rate hikes should make that company more instantly profitable? It sounded fantastic! Then today, Dimon talked about how an economic hurricane could be coming our way. So we all better brace for the disaster. What the heck happened to the halcyon era for the banks he mentioned a week ago? Did the sunshine turn to gale force winds and treacherous rain in just a few days? I think he crushed the market with his comments. He giveth and he taketh away. Whatever the reason, when CEOs are painting such an inconsistent picture, you end up with a market like this one that moves in fits and starts with aggravating ups and downs. They actually left the S&P 500 basically flat for the month of May. Oh, it's very easy to hate this one, especially if you're playing the ruinous game that so many younger investors turned out to be playing. We all know the classic examples, meme stocks like AMC, the movie theater chain that was at $62 last year, $62, but now trades at $12, after a brief blip up to $16 just yesterday on the strength of Top Gun 2 box office numbers. The run in AMC was spearheaded by CEO Adam Aron, who remains predictably positive on the stock. It certainly is right. It's been his right the whole way down. Darn thing took a 10% hit today. Or how about this? Let's just think of some of these. Let's just, look at the parade of horribles here. How about GoodRx? There's a good one, right? GoodRx, we had them on a bunch of times. Prescription drug discount app. It traded at $47 back in October of last year. And now, while it's at $7, Teladoc, which has fallen from $154 last November, $32 now. Oh, how about, let's throw in Carvana, used car retailer. See that stock plunged from $370 last August to $26 today? Don't forget the electric vehicle cohort. Lucid's gone from 55 to 19. Rivian's fallen from 172 to 30. Fisker's fallen from 23 to 10. By comparison, Tesla's been a trooper, but even that sunk from the 1200s to the 700s. Then there are disastrous battery and charging station stocks. QuantumScape, 40 to 11. EVgo, 19 to 9. ChargePoint, 35 to 12. Don't forget the revolutionary stocks. Roblox is going to disrupt the entire gaming ecosystem. 134 to 29. UiPath was going to automate office jobs, fall from 81 to 16. Although it's jumping after hours and wake up a better than feared quarter. Finally, there's fashion. Stitch Fix from 66 to 8. Rent the Runway from 19 to 4. Poshmark, 51 to 10. Ignominious Real, 22 to 3. Allbirds, 29 to 5. Warby Parker, 60 to 16. So what distinguishes these companies, aside from their disastrous performance and the fact that almost all of them lose money? Simple. These stocks are where the pain is really concentrated in this market. Because in many cases, they have almost nothing to fall back on. There's no buybacks to buoy them when they're down. Instead, they're often serial issuers of their own stock. There are no dividends, something a growth-obsessed buyer who used to love these things look down on because they're for old people. Those are old people's stocks. There's no sponsorship to speak of. Nobody, any brokers from a repute that can really pound the table on them. Instead, we just see endless price target cuts, one after another after another. But most of all, these beaten down names represent a fundamental misunderstanding of how you should manage your money. I spend a huge amount of time analyzing just these kinds of situations with the CNBC Investing Club as we go over our holdings in the charitable trust. Oh, we do it pretty brutally. We hold ourselves responsible, as you'll see if you join in when we host our monthly virtual meeting tomorrow at noon. So let's go over what's going wrong here, because that's the only way we can learn from the colossal losses these broken momentum stocks all generate. First, when you take this kind of loss, you can't despair so much that you give up on the stocks as an asset class. Because what happened here is people really did start with a very fine premise. They liked the company. They liked it enough, so they bought the shares. They were all birds and thought, oh, how cool. They can own the stock. They rented the runway, saved a ton of money by not buying a dress. They used their cell phones to speak with doctors and loved not having to go in person. They wanted to support electric vehicle makers. Who doesn't want to find the next Tesla? Why not back the safest, most child-friendly gaming platform in the world with Roblox? You know what? That's a terrific starting point. But the problem is the homework, or in this case, the lack thereof. Wanting to invest in something like that's terrific, but you also have to know the financials. How the company's doing. Is it losing gobs of money? Does it have enough capital to last? Does it have a path to profitability? If you don't ask these questions, you're asking for trouble. It's only a good place to start. Then you have to ask yourself, do these companies have the feel to themselves? There turns out to be so many charging station and battery investments in electric vehicles that no one can break through or stand out in particular, or stand out before the money runs out. There's so many competitors to Allbirds and so many copycats to Rent the Runway or Teladoc that there's no moat to their businesses. And most important, when these companies are all collateral damage from what the Fed has to do to tamp down inflation, it's unnerving, and you don't see it coming. The Fed's cutting off the easy money that helped create to save us. It helped create to save us from a COVID-related meltdown. That was right. But because they printed so much money, everybody could get financing. And you end up with a situation where just about anything can come public. That's inflationary. There was no governor in the system. Certainly not the brokers who made billions of dollars off these deals. Off you. Even as the stocks have imploded in the last 6 months. Which brings me all the way back to Jamie Dimon's weather report. What he's saying when he talks about a hurricane is the inability of the Fed to crush inflation without also crushing the economy. I want you to imagine a hurricane hitting a coastal area. What house do you want to be in? One that's shielded by a big profit stream with a fortress balance sheet, not to mention a dividend or a buyback? Or one that's just an idea or an unprofitable product that happens to have a stock connected to it that you got trapped in? Oh, hey, look, I'm not against growth. I love growth. Last night I talked about how Amazon, Alphabet, and Meta platforms, formerly known as Facebook, have great balance sheets, fairly consistent growth, and big moats. I know now, for instance, that many of you are worried about the future of Meta now that longtime Chief Operating Officer Sheryl Sandberg announced her resignation from that post today. Now, I know when I spoke to her tonight, I was concerned about the vacuum she might cause after working there for 14 years. And is CEO Mark Zuckerberg's longtime co-leader going to take the whole business with her? I mean, she was really part of the whole growth and prosperity. No, that's not going to be the case. She reassured me about the company's big bench and that time was right for her to focus on philanthropy. Strong companies like Meta will weather the storm, and their stock should be bought on this weakness. Although I have to admit, I will miss Sandberg's tireless effort to steer the company toward helping small businesses prevail, especially during the pandemic. But buy this stock on this weakness. I will say that again tomorrow. I will say it for weeks, months, years. In the end, the new class of disappointed investors needs to start over. This time with an understanding that a product you like doesn't always make for a fantastic investment. As I tell investment club members all the time, there's a right way and a wrong way. Doing the homework about the underlying company and knowing how the economy might impact it, that's often more important than whether you like the product. The bottom line, if you don't know how the companies you own shares in will survive an economic hurricane or even a Fed tightening or two, then just use the product. But don't own, as Leon Trotsky would say, the means of production. Kelly in Minnesota. Kelly!
Hi, Jim. How are you?
I am good, Kelly. Good to hear from you.
Great. Listen, I want to thank Nicole for taking my call. She's great. You've got a great staff.
Nicole is terrific, has smile, works hard, makes us all happy. What's going on?
So I'm newer to investing the last few years, and I've been learning a lot, reading a lot, and January came, and I was like, what am I doing in this market? My brother is very dedicated to you, watches you all the time. So I turned your show on, and everything you said was just making absolute sense. So I joined your investing club. I've been reworking our portfolios, but there's one stock that's just a thorn in my side, and I'm not sure if I probably should have got out of it sooner, but it's Fubo TV. I don't know if we just ride it out and stay long or cut a huge loss and reinvest.
Well, remember, it doesn't matter whether you take the loss or not. You have a loss, and I think you're going to get some gains. We're going to do some good stuff with the club. You'll have, and I think that what you ought to do is wait till the end of the year, and if you got those good gains, like I hope you have, you'll take the loss against it. That will be the plan. Okay, we're going to Dino in Minnesota. Dino.
Jimmy Chill, thank you very much for taking my call, man.
Quite welcome.
Hey, I took your advice a couple years ago back in April of 2020, bought the stock. Now I cashed out of it. It was about 6 months ago, and it's back down to pandemic levels. Wondering what you think about Wayfair.
All right, so I'm so glad you asked me this call, Dino. I mean, these are great calls. Kelly, thank you for being in the investment club. Dino, listen to me. There's a company called Williams-Sonoma. It reported the same time as Wayfair. This company is on fire. It is doing every right. It's buying back its stock. It's run by a genius, Laura Albert. And it is all the way down, off 26%, down 2% today to 125. And that, my friend, is that's the furniture company you want. Now, if you don't know how the companies you own will do in an economic hurricane, thank you, Jamie Dimon, for that weather report, or even a Fed tightening, then just use the product, but don't own the stock. Hey, on Mad Money tonight, you stumped me on a couple of lightning round stocks that I'm going to turn to my homework on 2 names that Cramer has its eyes on. And oil and gas companies have reshaped their image. So is it time to embrace the change or just kick them out the door? I'm going to give you my oil manifesto. And Sentinel One reported top and bottom line beat for the quarter, and that there was a quarter after reported at the bell, and I'm running through results with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.